Hey, welcome to today's video. My name is Paula Snow, and I am here with my friend John Scapin, who is with Primary Residential Mortgage, and he is my lender friend, but also a lender expert. John, you've been doing this for such a long time, and you are a wealth of knowledge, and we have worked together with so many customers that I figured it would be great for us to get together and just give people an update as to what's going on with mortgages right now, especially with a change in interest rate. So you've been doing this for how long?
Been doing this for 25 years.
That's a lot. Hey, I've been doing real estate for like just over 25 years.
I don't want to age myself.
I know. Well,
Yes, I've been doing it for 25 years. So I've seen all the ups and downs come and go.
yeah,
So interest rates have been really low,
yeah.
as low as 2%. And they've been as high as 7.875.
Is that the highest that you've ever seen it while you've been doing this?
7.875. Now we're approaching the fives. We're 5.875
Yeah.
on average. And I feel like they're coming down.
Yes.
There are trends that we watch, and interest rates are predicted to be dropped by the Federal Reserve at least twice this year, specifically to spur more mortgage applications and first-time home buying. I predict that we'll be in the high fours by the end of the year.
Sweet.
I don't think we'll ever get back to the 2.5% rates that we saw a few years ago, but I predict that we'll be in the fours. Now, what will happen if we get there is we'll have many more buyers.
Yeah.
We'll have a buyer's market.
Yeah.
There'll be a demand for houses. What usually happens with supply and demand, prices go up.
Yeah.
The higher the demand. So my point is, buy now. Now is the best time to buy. Keep your price low.
Yeah.
If the rates get really low, like well below the 4% range, we can always refinance down the road.
Do you think that if the rates are to get to the fours by the end of the year, is that going to insanely? Because I notice every time we have a rate drop, it puts buyers back in the market because now they can afford, more home. And so right away, I think you can definitely feel the difference. So, but what I don't want to see is, like we had a few years ago where we were doing 10 offers to one house. And then these first-time buyers had no chance because they were getting beat out by somebody that was paying cash and they were financed. Maybe they were doing 100% financing, needed some closing cost money. So in the high fours, is that going to still be a stable market or is that going to be crazy busy?
It won't be as crazy busy as it was when they were in the twos. That will be one of the challenges you'll have to deal with. Closing costs being paid by the seller will not go away, but it will be reduced drastically.
Yeah.
First-time home buyers will always have an opportunity to buy a house, but that would be the other challenge of waiting to buy when rates come down, and why I always tell people, buy now.
Yeah.
There's no greater investment long-term than real estate.
Right. Yeah.
It will always be the safest investment you can put your money into.
Yeah.
I totally believe that. Always have, always will.
Yeah.
So
let's talk about our area is unique in that I feel like we see buyers use all of the different loan programs, probably because we are very military heavy. So we see a lot of VA loans. We have a lot of FHA with first-time buyers. And then, of course, we do USDA if you're in a rural area, and then conventional.
Yeah.
So let's kind of get into each of those. So if somebody is looking to buy a home right now, how do they figure out which of the loans they go with? Like, let's say they're not military related. So VA is not an option. How do they figure out if they're going to go USDA, conventional, or FHA?
okay, for a borrower that has their own funds to put down,
Are we talking down payment?
down payment wise, down payment and closing costs. If you have 20% down, which a lot of people don't,
Right.
but if you do, That's the best option is a conventional loan with 20% down.
Because why? Because of PMI?
You don't have to pay private mortgage insurance.
Okay.
And rates are usually a lot lower for people that they're better if you put 20% down, especially if your credit scores are 740 or higher.
Okay.
You're going to get a better rate. Conventional loan is at the top of the heap of loan programs for those that have the money to put down.
Okay.
Now, there's an FHA loan.
Okay, hold on. Before we go to FHA,
Okay.
because you mentioned the 740.
Mm-hmm.
Okay. But okay, if somebody doesn't have 20% down, right? Because you can do conventional with 5%.
You can.
Okay, so is that the minimum? 5%?
5% down is minimum.
Okay. For
740 gets you the better score, the better interest rate.
But what is the entrance credit score needed for a conventional loan?
It's 620.
Okay.
However, 620 doesn't guarantee approval.
Okay.
There are compensating factors. Your debt to income ratio at 620 has to be really low.
Okay.
Your housing ratio has to be really low.
Yeah.
So basically, your total payment with insurance, taxes, and mortgage insurance divided by your gross income, not net, not take home.
Okay.
Usually has to be under 30%.
Wow.
Which shows that you make 3 times the amount of your mortgage payment.
Okay.
If you have that and you have a lower score at 620, it will probably approve you.
Now, what about somebody that has a 620?
Mm-hmm.
And nowadays, I mean, these car loans are the payments are really high.
Yeah.
So how about somebody that has a 620, but they have a $700 car payment? How is that going to affect? Do you see where that affects people, those high car payments?
Absolutely. It depends on what their income is.
Okay.
It depends on what other debts they have.
As long as they're under that 30%.
Well, the 30% is your housing ratio only.
Okay. What about with debts?
The back debt to income ratio usually has to be under 45.
Okay. So
if you have a lower score.
Included 45%.
Now, if you have great credit,
which would be what?
740 or higher.
Okay. So not even 700 is not great credit.
Well, yes, I'm talking the best interest rate would be at 740, but 680 or higher is considered really good credit.
Okay, so you heard that. If you have 680 or higher, you're doing good.
Mm-hmm. So basically, if you have in that range of credit score, you can be right at 49.9% on your debt to income ratio. The front end ratio we talked about being the home payment ratio. Back end ratio is the home payment, all of the debt added to it combined, and then you divide that by your gross income. That has to be under 50 for a conventional loan.
Okay. And so sometimes I've had people that have had medical debt.
Mm-hmm.
And so is medical debt included in that? Does it have to be calculated into that back end ratio?
No. Because usually medical debt, if it shows up as a collection, that collection has already affected the credit score some.
Okay.
Not a lot, but you don't have to figure. Usually if you have a collection, which is an account that you haven't paid, and you're getting phone calls, hey, you need to pay this. We have to take 5% of that collection as a debt.
Of the total amount.
Unless it's medical, then you don't have to worry about it.
Okay.
We forgive medical.
Okay, that's good to know because I remember we worked with a customer probably like 15 years ago, and I feel like she had some medical debt, and that's where, she thought she wasn't going to be able to qualify because of her medical debt.
But she did.
And she was so happy and pleasantly surprised, and we are still living in that home, and they've had a baby together. And so, I mean, it just totally changed their lives to be able to do something that she didn't think was going to be possible because, people have these preconceived ideas of what they can and can't do in terms of qualifying for a loan. So this is why I say it's so important to talk to a lender, somebody like John who is experienced. And I do want to put a plug for you, John, because mortgages is all you do. So whereas like if I were to walk into my bank, you could go, apply for a mortgage, but that person there is also doing like credit cards, issuing new debit cards, doing all sorts of other things. So they are not totally versed in just mortgages.
Right.
Whereas mortgages is your language, 1,000%.
Tell people I may not know a lot about a lot of things, but I know mortgages
Yes,
because
you do.
I have done them all my life.
Yeah. And so, okay, something else I want to mention is rapid rescore.
Oh yeah.
Because this I've seen be such a blessing to so many people. And so who would explain rapid rescore and talk about who would that be beneficial for?
Okay, so if we have a borrower whose scores are marginal, let's say they want to do a first-time homebuyer program, and typically you have to have 640 or higher for those. Let's say we have someone with a 590, and we would need to get them above the 640.
Mm-hmm.
There are things you can do quickly with a rapid rescore to get it there. So, for example, if you have a credit card with a credit limit of $2,000 and you owe $1,900 on it, you're maxed out on that credit card. That really hurts your score. So I tell people 25% of the credit limit. So on $2,000, you want to be below $500, but you don't want to pay it off.
Right. Because that will really hurt someone to close an account.
Because you want to have a little bit on it to show that you can manage your credit responsibly.
And that is so important. That is such a great key tip to highlight. One, do not max your credit cards out, even if you're paying them off every month, because then it looks like you're always living to your max.
Right.
And so you don't want to max your credit cards out. So having the self-control to keep it below that 25% number is so important. Yeah.
So what happens is, once you get it to that point, let's say you have several revolving accounts, credit cards. Revolving accounts could be Home Depot also. It could be Lowe's. It could be Best Buy. If they're all maxed out, they're hurting you. So you pay them down to the 25% or below mark.
Oh, is that the key for rapid rescore? Is getting them to the 25%?
Or lower.
Oh, okay. Or lower, yeah.
Because the credit bureau looks at revolving account utilization.
Oh,
and if you've just maxed out all your spending ability or potential on credit cards, it's not looked upon favorably because interest rates are very high on credit cards.
Yes.
If you're maxed out on your credit cards, you're paying 30%, almost 30%.
Crazy.
Okay. So what happens? You pay these down, and then
so when people come to you and you recommend this to them, do you give them the specific amount to say, hey, I recommend you pay this amount on this card and this amount on? So you do all the calculating to figure out where's going to bring them to that below 25%, and you're telling them what to.
I don't necessarily assume that they can add or do math.
Figure it out, right? Yeah.
So I do the math for them.
Good.
And then I tell them I need a letter from the company on letterhead with the account number and their name, stating the new balance for this Capital One credit card is now $389 as of this date.
So why do they need the letter if the next statement is just going to show the new balance?
Well, if they want to wait till the next statement, sometimes the statement takes longer to come out.
Okay, so if we want to speed up the process.
If we want to speed it up, I can get a letter right away. So what I do, I go to the credit reporting company, I log in, I put in the credit report that I pulled already, and I hit rapid rescore, and I make all the changes to where this credit card has been paid down, update balance. I choose all the credit bureaus, then I upload the letters.
Great.
And then within no more than 3 days, they say, okay, your accounts have been sent to the credit bureau. Here is a new and updated. Here's a new number to repull credit from the other credit report that you pulled. So it doesn't hit you with a hard pull.
Okay.
It updates the pull that you already did, but it gives you another number to put in when you order it.
Okay.
So then you put that number in and you order it and you hit it. And then that's the greatest feeling in the world when it comes up and it's like, okay, now you're 650.
Wow. So what's the most that you've ever seen somebody, like, do you recall what was their credit score before? And then
I've gone from 590 to 700.
That is crazy.
Because credit cards are not the only way to get them up, but it's one of the biggest ways.
Wow.
And
see what I'm saying? This guy is a mortgage genius. I don't
know about that, but thank you.
You are.
Yeah.
You are. I just want to, give some backstory to how we met. Was you came to my old brokerage and to do like an explanation on mortgages and different mortgage products. And so at the time when I met John, I don't know if I had just gone through a divorce or I was going through or completed a divorce, either way, and totally destroyed my credit. And so I remember at that point, I went to you and I said, John, like, am I ever going to be able to buy a house? I have these 2 little girls. My twins were 4 at the time.
Yeah.
And John was you were amazing. Not just are you knowledgeable, but I have to say, you are so kind and compassionate. Empathetic. Yes. And so I really always felt like you cared about me at the time as a single mom.
Mm-hmm.
And John said to me, Paula, I'm going to tell you exactly what we're going to do. And you said, okay, you're going to need to reestablish your credit. You're going to need to get 3 credit cards of some sort. And at first I couldn't even get a credit card because my credit was so bad because of this 2 years of non-payment. And so you told me, you said, go get a secured line of credit.
On your savings balance.
Yes.
Basically.
And so I did that. And then after I did that, you said, okay, wait a couple months and then you'll be able to get. And sure enough, it was like you walked me through step by step. And so I remember.
And now look at you.
I know. And it's like.
Now you have homes, you have.
Yes.
You have businesses.
I mean, and I have to say, God has been so good.
Oh, yeah.
So God definitely placed John in my life to walk me through some of the hardest periods of my life, which was reestablishing my credit. I was able 2 years later, and you told me, you said, Paula, it's going to be a 2-year process. And sure enough, like to the date, 2 years later, I was buying a brand new construction home, moving in with my girls. And we lived in that home for, 2.5 years before we moved. We kept it as a rental. And that home has been such a blessing to us. And people have asked me, tenants have said, would you sell this home? It's like, no, this home is so special. Yeah. We have so many beautiful memories there.
Yeah.
And a lot of that, I have to say thank you to you because you walked me through the process. You held my hand. And I always tell customers when they say like, oh, I don't think I can qualify right now because I had a bankruptcy or I went through a divorce or whatever it is. And I always tell them, call John, he will walk you through the process.
Even if you think you can't qualify, if you want to eventually buy a house, I will speak with you. I will run your credit and I will not charge you for it. And basically give you a blueprint of what you need to do. And the problem is I give a lot of people blueprints and they don't follow through. You have to do it. You have to be.
Yeah, there's no point.
If you're spending, I don't mean irresponsibly as you're irresponsible, but if you have spending habits that are not always the wisest, some of that has to be cut back. How bad do you really want to get to that point to buy your home?
Right.
You can't eat at $100 restaurants 3 times a week.
Right.
If that's what your goal is.
Yeah.
You have to make sacrifices. But if you do what I suggest, and I'm not saying I'm some kind of genius, but experience has taught me a lot of things. Yeah, that's all I can say. I've been doing this a long time. So I will help anyone. Okay. And I will speak with anyone.
Thank you.
Yeah.
Okay. So we talked about rapid rescore. We talked about conventional. Now let's talk about VA because we are a military heavy town. And so tell us about VA.
VA is for anyone that served in the military or the reserve. There's a minimum time that you have to be in each to qualify, but a VA loan requires no down payment at all.
Right, 100%.
100% loan.
Yeah.
Rates are usually a little bit better on VA because we are very thankful for veterans and their service, and the rates reflect that. For veterans that are disabled, they don't have to pay any kind of mortgage insurance at all. They're totally exempt.
So is that the VA funding fee?
The VA funding fee is an insurance that is collected on VA loans in case of default. It helps who's ever servicing the loan recover their money. So basically, we don't really need to get into too much on that, but if you're disabled, you don't have to pay that. And it's really nothing you pay out of pocket. It's rolled back into the loan. So
yes. Like it's not, you don't have to come up with the money at closing. So Now, is it for any, because there's different degrees of military related disability. So do they have to be a certain percentage? No.
Even if you're 10% disabled, you don't have to pay it.
Really?
Yeah.
Oh,
If you're
okay.
100% disabled,
Okay.
you don't have to pay property tax.
Yes.
That
is a huge.
That's huge.
benefit. Yeah.
So you know, 100% loan. All you have to pay for it, closing costs, which are a little bit reduced, not much, but a little bit.
So on average, I always give people the number. I tell them somewhere around 4%. Is that a safe number to give people for their closing costs?
That's way safe.
Okay.
Way more, usually way more than what they'll pay.
Sometimes I've looked at it, it's like 3.6, 3.7. So, and then depending on price range, then if you go higher, then that becomes too high.
Yeah.
So, but somewhere under 4%.
Right.
Okay.
Right. So, I mean, 4% on 500,000 is 20,000.
Right. Yeah.
So, I mean,
and it's, then the number didn't translate. Once you get too high. So,
but they're great loans if you qualify. And there's really nothing difficult about them.
Yeah.
A lot of people think that they're hard to do or hard to qualify for. They're not. They're actually easier to qualify. If you have a score, let's say it's not a pinpointed amount credit score or number, but if you have good credit, your debt to income ratio on a VA loan can be super high. It can be as high as 70%.
Really?
Yeah. As long as you're
70%, is that all encompassing all debt?
Yeah.
Why can it be so high?
Well, it does look at the housing ratio.
Okay.
Well, actually the residual income. So if your ratios are let's say they're 70%, but you have, after you pay all your bills, you have at least $1,500 to $2,000 left over still. It looks at residual income, and it looks at the fact that you have good credit and you're a veteran and you're good to go. I've done many VA loans for people that would have never qualified had it not been a VA loan.
Wow.
Because of the ratio.
That's really good to know that, our service members are being taken care of.
They are.
And that they have these special circumstances where a higher debt to income is taken into account for them. So that's awesome.
I have a soft spot in my heart for veterans, and all our employees do, and our underwriter especially. Have a great underwriter. She has a very soft heart for veterans.
Awesome.
Like, she has made exceptions. And I'm not saying call me for an exception. I'm just saying,
everybody's going to call you for an exception.
she just, like, if it's close, she'll always go with the veteran and help them.
That's nice.
Those are great loans.
Yeah.
And we do a lot of them because we're a military town. We do many VA loans.
Awesome.
Yeah.
Awesome. Okay, let's talk about USDA loans and then FHA.
Okay. USDA loans are rural housing. They are typically in our area, Santa Rosa County, Milton, Pace. Even though they're not really rural, they've been grandfathered in.
Yeah. And of course, Jay
and Beulah. And
so not Gulf Breeze. So don't call and ask John to do a rural loan for Gulf Breeze or Navarre, because that's not rural.
Not going to happen.
Yeah.
If you're north of Highway 29, past the paper mill in Cantonment, that usually qualifies.
Okay.
So that is 100% loan.
Yeah.
There are stringent housing ratio and debt to income ratio guidelines that make it, that's the challenge with them. Not always a challenge, but if your housing ratio is not below 34%.
Okay.
So basically you take the payment, divide by the gross income, just the payment, that has to be under 34%. So if that's too high, you can't do it.
Okay.
Because they want to see that your payment is 1/3 of what you make, basically. That you can afford it.
Okay.
It's not really a first-time home buyer program, but it is. Like, you can have had a home last year and sold it, and still do USDA the following year, like immediately, as long as you don't currently own a home.
Okay, so you can't keep the old one as a rental.
No.
Okay. And say, I want to get another.
You can only have one house at a time.
Okay. Now, the other thing I found peculiar about USDA is that, do they still do this where they take everybody's income from whoever lives in the house? Meaning, like, even if you have a young person living in the home, like, let's say I've got Sophia living at home and she's got a job, right? And if I were to go and apply, let's say I didn't have any homes and we were renting and I was going to apply for a USDA loan and just want to use my income, because there's income limitations, like, right? Like you.
Exactly.
So
Yeah.
for example, for like a family of 2, you can't go over, you can't make more than a certain amount.
Correct. There's a limit, but that limit has gone way up.
Okay.
So, last I checked, it was like over $110,000 a year
For the family.
for the family.
Is that including if you have young people living at home?
That's including if you have young people living at home.
So their income is also going to be taken into consideration?
Yes.
That's the tricky part.
That's the tricky part.
With young people, you might know they're going to move out in the next couple years.
Yeah.
So it's like, well, does their income have to affect,
Yeah,
affect you if you know they're leaving?
exactly. Well, the mentality there is, if you're making that kind of, over the limit, you shouldn't really need assistance. You've done well for yourself. You should be able to qualify for that, for a regular loan. But it's there, and we do them, and we know how to do them well. So that's another tool that we have to offer.
Yeah.
Yeah.
Okay. FHA?
FHA is the most lenient loan on the planet.
Okay.
It's typically taken by first-time home buyers, but not required. You don't have to be a first-time home buyer. You can only have one FHA loan at a time.
Okay.
So if you had another home with an FHA loan, you cannot do another FHA. It's 3.5% down. So this is 3.5% lower down payment. You are allowed to go up higher on your ratios. Debt to income ratio can go up to 55.9%. You have mortgage insurance that you pay every month in your payment, regardless of how much money you put down, which typically is only 3.5%. But some people want to put more down. They have really low credit. They can't qualify for a conventional loan, but they don't want a huge loan amount.
Right.
You're still going to pay mortgage insurance regardless.
Okay. For the life of the loan.
For the life of the loan.
Yes.
And then you pay it up front as well. So basically, after you determine the loan amount, 1.75% gets added on top of the loan, like a funding fee, like VA has.
Yeah.
So they cover themselves for the risk.
Yeah.
But you can go down to 581 with only 3.5% down on an FHA loan.
That is low.
And many times now, when you're down that low, you have to have your debt to income ratio can't push the limit.
Okay.
They look at a lot of things, but now if you go below 580 and you really want to buy a house, and you have money, you can put 10% down and possibly get approved for an FHA loan under 580.
Okay.
I've done it down to 540 before.
Oh, interesting. Okay.
For people that have money to put down.
I just don't have the greatest credit score.
Right. And their debt to income ratio is normal.
Yeah.
It's not too high.
Yeah.
It's within limits. And that's there. And I can tell you, I can just usually tell by looking at your profile if it will approve you or not. But again, let me do my thing.
Yeah.
Yeah.
Okay. One thing I forgot to ask on VA, what is the current max loan limit?
700. It's in the low 700s, I believe. Yeah.
Okay. Which for our area is plenty.
It's plenty.
Yeah.
It may be even higher than that, but without me looking it up.
Yeah. Because things are always changing.
They're always changing. Yeah.
Yeah. I don't mean to put you on the spot, but
it's close to 800,000.
Okay.
Yeah.
Okay. So with that, I do want to explain, if somebody decides they want to buy a home for, let's say, $1 million, and they want to do a VA loan because they want the benefits of the VA loan, they can buy a home for whatever price they want to. The VA is only going to loan out up to that max amount.
That's how it used to be.
Oh, did that change?
So the county limit only applies if you have another VA loan outstanding already.
Okay.
Okay. So if you have another VA loan, let's say for $400,000, and you want to buy another home with VA and rent out the one that you had before, you can only go up to the 740 or whatever between the two loans.
Yes.
Don't ask me why that rule is different than if you don't have any other VA loan out.
Okay. Okay.
You can go up to $1 million with a VA loan, and they'll insure the whole thing.
Okay. Yeah. Okay. That's interesting.
It's a high balance VA loan, and we do them.
Okay.
Yeah.
Okay. Okay, now let's talk about jumbo loans.
Okay.
So let's say we have somebody that wants, their dream home on the water.
Like the one we just did?
Yes, like the one we just did for 2.8 million.
Yeah.
Is it 2.8 million? Yes. Talk about that. Like, what does the process look like for somebody that's wanting a jumbo loan?
Yeah. The process is that you have to be strong.
Financially, yeah, definitely.
You have to be strong, obviously.
You have to make more than $100,000.
Yeah. You have to have assets, and it depends on the price of the home. There's no need to go into details on that, but you have to have money in the bank above and beyond what you're bringing to closing.
Yeah.
Usually, let's say your payment is $10,000 a month.
Yeah.
Usually, you have to have at least a year's worth of reserves, they call it, which is the monthly payment times the number of months that are required.
Okay.
So usually a year would be like 120,000 that you would need.
Okay.
You have to have a good credit score, and you have to have a good down payment.
Okay.
Yeah.
Okay. But I mean,
but we can do them.
Yeah, and you did a great job for the one we just did. So, and on jumbo loans, 2 appraisals, are they always 2 appraisals required?
They're always required.
Okay.
Yeah.
So what price range would be considered a jumbo loan?
It's close to, it's in the 800 now. It's above 870, I believe. Again, they changed a lot. And when I get one that's close, I have to look it up.
Yeah.
But I believe it's in the 800s.
Okay. But anybody that's looking at $1 million and above, that's going to be jumbo.
If they're looking at $1 million and above, and they put enough down payment money down to get to the 850, they can go right. They don't have to do jumbo. It's based on the loan amount.
Oh, gotcha.
Yeah.
Okay.
So if they can't get down to that with a down payment, then it's jumbo.
Okay. Got it. Okay. So, and then share with us this exciting information you were just telling me about doing the condo tel.
Okay. Yeah. If we have an investor.
Oh, yeah. Actually, we haven't even talked about investors. Yeah.
If we have an investor who, let's say they have 20 properties, you cannot do any kind of conforming loan with 20 properties. Usually you can only have 10 loans with loans to do a Fannie Mae loan. So if they're paid for, they don't count, but you can have 10 loans. Anyway, it's called a DSCR loan, debt coverage ratio loan. Basically, if your payment is covered by the rent, that's the premise of what qualifies you for that loan. So if your payment is $2,500 and you're bringing in $2,600 a month, you're good. You don't have to provide any income verification at all.
So is that
no pay stubs, no nothing.
Okay, so no doc loan.
You have to show where the money for the down payment is coming from.
Okay.
You have to have a certain credit score usually.
Yeah.
You have to be a little bit stronger. And depending on your down payment, if you put more money down, your payment doesn't have to be covered by the rent. It can actually be half by 0.5. It goes by 1 if it covers the payment.
Okay.
Anything below is a percentage, 0.75, 0.5. Okay. So if you put like 30% down or more, it's very forgiving. You can go down on that.
Okay.
But if you go down on that, the rate goes up with it.
Okay.
But the average rate on one of these is 6.5.
Wow. That's really good.
They do have prepayment penalties.
Okay. Yeah,
that doesn't mean you have to prepay all your interest.
Yeah.
It means that if you pay it off early, you get penalized.
And so you were saying if they pay it off before 3 years.
Well, you can choose the prepayment time frame.
Oh, okay.
It goes from 2 years, 3 years, 5 years. The higher the prepaid year, the lower the rate.
Okay.
So if you're an investor that just wants to buy,
and you're going to hold long term.
And you're going to hold long term, and you're strong, and you have money to put down. That's the caveat. Okay. Not everybody has money to put down. You have money to put down, and you want to buy properties. You don't have to qualify with all the other properties that you have. Do not matter.
Yeah.
We don't even put them on the application.
Okay.
We're just looking at that one.
Okay.
It's a great program if you're an investor that has cash. Perhaps you have many homes out there, and every now and then you flip one. You have the cash to put down on a new one. DSCR loan would just make it simple.
Yeah, that's awesome.
And these are for people usually Usually you can do them in an LLC also. You don't have to, it doesn't have to necessarily be in your name. Yeah.
Oh, that's great. That's great. So if they go and set up a brand new LLC, does it have to be an established LLC? It can be a brand new LLC.
Yeah.
That's awesome.
Oh yeah.
That's really good.
Yep. And we're doing them now, and we haven't always done them. I've always been reluctant to take on stuff that hasn't been necessary, but I've always been intrigued by it. So we jumped into it, and it was easy to do. I didn't have to provide. Oh, the one that I did was a condo hotel.
Yeah.
It was.
And you said that was over in.
It was Perdido Sky Resort.
Okay.
And it was a condo hotel. Fannie Mae won't touch a condo hotel. Even on the condo questionnaire, it said yes, hotel services. There, is this basically a hotel?
Yeah.
And the interest rate went up some.
Yeah.
We ended up doing the interest rate was 6.75. It was a condo hotel, and the debt coverage was a little bit under 1.
Okay.
Just because it was newly established, and I still got 6.75 with a 3-year prepay.
It's not bad.
Yeah.
So for somebody that is looking to do that, because the rent is going to be taken into account, what if it's something that is not currently rented? Is that okay? Is it with the future expectation?
What happens
or
is,
does it have to be already
if it's not currently rented, then they will go off of the appraiser's rent schedule.
Okay.
And the one that I did was an Airbnb. It was a short-term rental.
Okay.
It was, so we had to get the income that it generated for the past year.
Okay.
And it was the lesser of that, of what the appraiser came up with.
Okay. Great.
So yeah,
that's really good that they're getting flexible with all the way they're doing these bulk purchases.
Yeah, I know condos in the past have been a problem for many people.
Yeah.
Because they're not always approved by Fannie Mae or even VA. But if you are an investor with cash, I think you have to put at least 20% down. I have a loan for you. Yeah, I can do it.
Yeah. Awesome. Well, any other closing thoughts that you want to share?
We have first-time homebuyer programs.
Oh, yes. Okay.
One of them is Hometown Heroes. If you work as a nurse or a law enforcement person, there are certain fields that qualify for that. Then you can get 5% of your loan amount as, it's not free money, but it's use of free money. So basically you get 5%. It's a second loan. You don't pay any interest or payment on it. And you only pay it back when you sell or move out or refinance. And basically it's a second mortgage that will be accounted for when you're trying to clear your profit from what you owe on your first mortgage. It would just be, let's say the amount is $15,000. There'll be another $15,000 added to your payoff, and then you get rid of it. But it's free use of the money. Many first-time home buyers don't have any money to put down.
So you use that for down payment
and closing or both. Yeah.
Okay.
And you don't work in a specific field where you can get Hometown Heroes. You can do bond. Florida Bond. The Florida Bond program gives you $10,000 to apply to down payment, closing costs, or both. Same thing. It's forgiven when you sell, move out, refinance.
Now, on bond, you have to live there for a certain amount of time before it's forgiven?
No.
You don't?
No. Bond is never forgiven.
Oh, bond is not forgiven.
It's not forgiven.
I'm thinking of
You're thinking of SHIP.
Okay.
We can get into SHIP, but they don't have any funds right now, but I can get into it. So bond, you don't have to, it's never forgiven. So it's not a problem.
So that's considered like a soft second mortgage.
Right.
Okay.
So for the bond program and Hometown Heroes, you have to have a 640 or higher. Your debt to income ratio, which is your mortgage and all your debt, has to be under 50. And then typically, if you're above a 640 and you meet that, it'll be approved. And we don't control the interest rates for these programs. They're through Florida Housing. They're advertised online. They are what they are. Sometimes they're a tad bit higher than what I can offer, but not much.
Got some reduced closing costs.
They have no origination fee, no intangible tax or mortgage stamps at all. And so, you make up for it there. But we do a lot of those. The other one that we were talking about was Ship. Ship, when they have money, is great.
So SHIP is a down payment assistance program. Is it only available in certain areas?
Well, it depends on the county. So
Okay.
we have SHIP in Santa Rosa County. We have SHIP in Escambia County. Santa Rosa County, you can get up, well, it's minimum $25,000. I'm just going to talk about Santa Rosa right now because SHIP has been out for a while in Escambia.
Okay.
I don't know when that will be back, but in Santa Rosa County, it's $25,000.
Okay.
You have to not have owned a home in the past 3 years. And basically, if you're approved for the loan that I'm going to do, if I approve you, then you're eligible for it if you meet their guidelines, which, first-time home buyer, it considers the whole household income. You cannot have over $25,000 of your own money savings in the bank. Now, if you have...
Does that even include, like, if somebody has a Roth IRA?
It does not.
401k?
It does not.
Okay.
As long as you don't liquidate that, it doesn't account for that.
Okay.
But $25,000 is the minimum.
Okay.
And there's a chart on how much money you make. If you make a lower income, they consider under $60,000 now lower. So I just did one for someone making just under $60,000 for 50. They gave $50,000 away. 50 grand. I did one for 50 grand. So this person took the 50 grand and bought a home that could have never afforded the payment on and put it all toward the down payment.
Keep their payment
and got the builder to pay the closing costs. It was a Acadia home, Blake Lewis, and that person got a great deal. New construction, a $50,000 SHIP loan. Okay, so SHIP loans are good for 10 years. They're forgivable after 10.
Okay.
So basically, after 5 years, half of it goes away.
Okay.
So if you're getting 25,000, 12.5 goes away.
That's amazing.
After 5 years, 12.5 goes away, and then 20% of the 12.5 for the remaining 5 years goes away. 20% for the last 5 years.
Okay.
For the remaining half.
Okay.
So then after 10 years, it's gone.
So this customer that you just helped, if they stay in their home 10 years,
it's gone.
So they just
50 grand. They got 50 grand free.
That's amazing.
Yeah.
I should have done that.
I know. They didn't have it back then.
I know.
The only thing is, when they get funding for this, they get a certain amount of money. And it used to be 10,000, 12,000. Now it's 25 and 50.
Yeah.
But the amount that they're getting hasn't increased that much.
Yeah.
So the money runs out quickly because $50,000 a pop will deplete it quickly. Even 25. So when it comes out, I advertise it, and I have people that I know.
That are on your wait.
Look, these people qualify for 225.
Yeah.
If they can qualify for 275 now because of that down payment, that puts them in a whole new range of homes that are available now.
Right.
Yeah, because you can't find much for 225 nowadays.
Yeah.
So that's a big deal. I wish they got millions and millions when they get funded.
Yeah.
That would just help a lot of people.
Yeah, that really would. And so for somebody that's looking to do that, you handle all of that for them?
Yeah.
Like they don't have to go to a different government office to apply there?
I do it all for them, and I get it approved, and I take a package to them.
Yes. To who? To them?
To SHIP.
To SHIP.
In Santa Rosa County, there's an office in Milton, right by Avalon Boulevard, and 90.
Yeah.
So what happens is they approve the loan, then they have to meet with the client to get their documents signed. They don't have to apply or do anything. They just sign. I do all that for them.
And is the signing now? Is the signing right at closing, or it's at another time prior to closing?
The signing is done at the office of SHIP in Milton.
Okay, prior to closing.
Prior to closing.
To closing. Okay. Yeah, that's a really, really great program. So, yeah. Well, thank you so much, John. This has been so informative. So thank you for taking your time.
Thank you for having me. Paula and I have been friends for a long time.
Yes.
And we both enjoy what we do.
Yeah.
And so if you need anything, be sure to call.
Yes.
And if you ever just have any kind of lending question, you can call me directly. And obviously with mortgage questions, you can call Paula. So
yeah, and we'll put all of your information right here on the screen so people can reach out directly, call, text, or email you. And or they can even fill out your link online to do the application if that's easier for them. So thank you guys so much for watching. We hope you have enjoyed this video on everything about mortgages. If you have any questions, we would love to help you. Reach out. All of our contact info is down below. Thanks so much for watching.
thank you so much. Have a good day.